we need to calculate the current break-even point first. You know, your break-even point basically is your BEP is equal to your fees cost, okay, divided by contribution. If you are with me, fees cost divided by contribution. Now the issue here is that the costs were lumped together. If you check this cost of sales now, in this cost of sales, there is an element of the fixed and variable cost. So you must first separate this cost. Then even other expenses too, there is elements of fixed and variable. And you know, your contribution is equal to fees cost. I mean, contribution is equal to revenue, your sales minus your variable cost. This is your contribution. So your revenue minus variable cost, that is your contribution. So that's the first thing you need to know. Your revenue minus variable cost, that equals to your contribution. So the first thing that we need to do is to quickly separate those costs. We separate the fixed cost. So it is when we are able to separate the cost that we will be able to now extract which one is our variable and which one is our fixed. So once we're able to everything, that's what we do now. So
Hi, Kazim. We cannot hear you anymore, and you're muted.
sorry, I'm trying. Let me change this network. It's misbehaving. Apologies, please. It should be stable now. Network is misbehaving. Okay, let's continue. I think there should not be any interruption again now. Apologies. Let's continue. There should not be any interruption again. So, as I was saying, we need to separate these two costs. The first one is the cost of goods sold. We need to separate it into variable and fixed. Then, these other expenses too that we have here, we need to separate other expenses into variable and fixed. So, these are what we need to do. So, once we are able to separate those two costs, then we can easily calculate our break-even point. Okay, we can easily calculate our break-even point. So then the other one is very straightforward. Your margin of safety. What is your margin of safety? Margin of safety basically is your projected sales. Let me give you that one now. Margin of safety is your budgeted sales less the break-even point sales. Okay, what is your total sales minus the sales at break even? That is your margin of safety. So let's do that first. So let's quickly calculate. So I'm going to separate cost now. So let me have my fixed cost here. Then I will have my variable cost here. Okay, so the first one I want to separate is cost of goods. So for cost of goods sold now, the total cost is 500 naira, right? And we were told here that the ratio of variable to fixed cost of sales is 7 to 10, 7 to 3. That means the variable element is 7 over 10, then the fixed element is 3 over 10, and the cost of sales is how much? is cost of sales is what? Is 500. So can you give me the 3/10? I mean, 7/10 is going to be the variable. Then the fixed will be 3/10. Can you do that for me, please? What is 7/10 times 500? I got 350. So 350 is variable. And that means the balance of 150 will be fixed for the cost of goods. So sorry, who doesn't understand this analysis, please? I want to know so that in case you want me to explain. So like I said, that if you want to calculate your break-even point, your break-even point is your fixed cost divided by contributions, right? Then your contribution is your sales minus variable costs. Okay. So for you to be able to do that, you must first identify which costs are your variable and which costs are your fixed costs, right? You must identify those costs very well. So we've been able to identify the cost of goods sold because they told us that the ratio of variable cost to fixed cost of sales is 7:3. That means for every cost of sales, 7/10 is going to be variable and 3/10 is going to be fixed, right? So if you check now, the other thing we need to check is this other expenses. Let us separate that one to other expenses. So for other expenses now, the total we have for other expenses is 140. And in the question, they said the variable cost that 35% of other expenses are variable. So 35% of other expenses are variable. 35% of other expenses are variable, meaning that the rest are fixed. Okay. Now, if other expenses is 140, so what is 35% of 140? That's about 49. So these are the variable one, 49. Then the fixed will be 140 minus 49. That's 91. So fixed will be 91 for this. So this is the total cost that we have. So can you give me the total? What's the total now? So this one will be 150 plus 91. I got 241. 241. Thank you. Then this one will be 399. So this is our costs, correct? This is our variable and this is our fixed. So now that we've known our variable and fixed, we can easily calculate our contribution now. So what is the contribution? Contribution is equal to sales. What's our sales? Our sales is how much, please? Our sales is 800, right? 800 minus what? 399. So what is the sales? 800 minus 399 gives us what? 401. 401. So this is our contribution. So if you want to calculate break-even point now, break-even point is equal to your what? Your fixed cost, which is 241, divided by your what? Contribution. Contribution is what? Is 401. So how much is the break-even point, please? So how much is the break-even point? I got 0.60. Break-even point is 0.60 units. So this is my break-even point, 0.60 units. Okay? Do you understand, guys? Do you understand, please? So this is my break-even point in units. Now let's do the margin of safety. So your margin of safety is your actual sales. The actual sales is 800, right? So the break-even of this, the break-even sales is going to be 800 multiplied by this 0.6. That's your break-even sales. So your margin of safety is going to be what? That's 0.6 times 800 minus 800. That's about 320 naira. So margin of safety is 320 naira. So whatever we have done now is using the current method. You know, in the question they said calculate the current, both the current and the projected. So now we have done for the current. So the next thing now is for us to do the projected, right? So let's do the projected break-even point and margin of safety. So, guys, is this clear or am I on my own? I've been talking and since. Do you guys understand what Emmanuel, you raise your hand, please speak.
All right. Good evening, Kazim. Good evening, everybody.
Good
So
evening.
I cannot see your screen again. No, I wanted to comment on something, but I cannot see your screen.
Okay, let me quickly share it. I
All
think
right.
I don't know what happened. Yeah, check now. Check, bro.
Okay. It's now. Okay. So please, can you go up a bit? All right. So I would assume that for us to get break-even point in units, it means that we are calculating contribution per unit for us to get break-even in units. But in this case now, we have calculated um that contribution figure is actually contribution in total, not contribution in units. So ordinarily for us to, I think the only personally I would think that the only thing that we can do here to calculate our break even is to calculate break even in sales. So we might need to calculate, I think, contribution margin ratio, that's selling price minus variable cost over selling price, for us to get the percentage that will divide total fixed cost by. I don't know if you understand what I'm saying.
You are correct, but you are going too far. Don't waste your time. You are going too far, actually. You are going too far. That analysis is not required. It's very clear. There are two things here. It's either you calculate your break-even point in units or you calculate your break-even point in terms of the total sales. So there is nothing that states that your break-even point must always be in units. You can as well calculate your break-even point in total sales, right? So if you look at this question, you have been given the total sales as 800 million. Your cost of goods sold at 800 million. So for you to know, so what you would do basically is just to assume that this total sales is like you are taking it as in units. All right. So that is the basic things we have. That is the basic things that we have. That is the principle that we've actually applied here as well. Initially, I was also confused. So I had to now load this question on ChatGPT to see the analysis, and the analysis align with mine actually. So you don't need to go through your contributions margin ratio. You're just, it's like you're going to from Lagos to Ibadan and you want to go through Abuja. That's waste of time, right? So if you come across this solution, just go ahead like this, the same way we've done it here, and I'm sure you'll be spot on. Nothing to worry about, bro. Okay,
All right.
so that's just my comment on. Yeah, thanks so much. That's my comment on that. So let's work on the other part, which is the projected. We've done the current. Now the next thing is for us to do the projected. So for the projected, and they said that they are both financial statements are in line with the current financial policy of the company as regard to sales ratio, net profit margin, retention ratio. So the company would like to see its sales grow at 20%. So that means the sales we have here, which is 800,000, they would like to see it grow by 20% for the foreseeable future. Then the ratio of variable cost to fixed. You remember that when sales grow, your variable cost will increase and other expenses too will increase. All will increase in proportion to sales. No, not variable cost. The variable cost the variable cost out of the cost of goods sold, it will increase in that proportion. Then your other expenses too that is variable will also increase because you are told that other expenses are variable and increase with sales. The only thing that will remain constant is your fixed cost. So let's look at this analysis again now. Let's look at this analysis now. So based on the new data, so uh new new sales data is what? 800. New sales data is 800 times 1.2 because they said the sales should increase by 20%. So this will give us how much? 800 times 1.2. That's 960. Then the variable cost of sales, that is variables too. You increase it by that same amount. So how much is the cost of sales that is variable? The cost of sales that is variable is 350, right? So just increase 350 by the same 1.2. Though there is a shortcut, you can just say all the variable costs increase by this. No crime in doing that. You can as well increase all your variable costs by 1.2. There is no crime in doing that, whichever shortcut works for you. But I'll prefer you disclose this in full so the calculator doesn't consume your mark. So this is 420. Then the final one is other expenses too. It will increase also by the same 1.2. Other expenses is 49. So just say 9. So we have how much? 49 times 1.2. That's about, I got 58.8, right? 58.8. So that's what I got. So my new contribution now is how much? So if we do this, my new contribution will equal to 960 minus 420 minus 58.8. So my new contribution will be 481.2. 481.2. So what's going to be my new BEP now? My new BEP is going to be fixed cost. You know, fixed cost does not change. Okay, 241 divided by 481.2. 481.2. So this equal, this is a new one. So 241 divided by 481.2. I got 0.50 here. This is my break-even point in units. So you can just do your margin of safety again now. So your margin of safety will be budgeted sales. Real budgeted sales is now 960. Okay, 960. Then it's going to be 960 on 0.5 now. 960 on 0.5. So what's the new budgeted sales? What is the new margin of safety? 960 times 0.5 and 960. I got 480. So my new margin of safety is 480. So I think I am done with this question. So any questions for me before we move on to other area, other scope we have for tonight? Somebody said, Casey, we are not hearing you. Is that correct? Really? Aziz, can you guys hear me?
No, yes, I can hear you. No, I didn't say so.
Okay. Any questions
Flash
for me
back to
on
the
this
solution,
break-even?
please. To the solution, Casey. To the solution.
Yeah. Don't worry, I will share this with you. Don't rush to write it. I will share it with you. Don't worry. Because I want to move on to marginal and absorption costing immediately. I need to discuss marginal and absorption. I will solve a question. Then when I'm done with that, I'm taking standard costing straight away as well. So no time. On marginal and absorption costing, I will do one thing for us tonight. Okay, are you still reviewing the solution? Can I continue with my other story? Hello, guys. Are you still reviewing the solution? Can I continue?
Yes.
Can I continue? Okay, so we are moving on to a new topic now. So this topic, actually, what triggered this topic is based on popular demand. Everybody requested for the same thing. Initially, I don't know what to even think other than solving this question. So due to popular demand, we are reviewing two topics tonight. The first one is the standard costing. Then the second one is marginal and absorption costing. So let me close this question bank now. I'll open a new file, which contains all our notes. So for marginal and absorption costing, I have a question. Wait, so. Okay, fair cashman. I thought the question did not save. I will have a question, a lower question that is solved for us in class. That is what we're taking tonight. So first of all, let me explain what is a marginal and absorption costing. Let me spend like 2-3 minutes to explain. I will explain this marginal and absorption costing, then I will also highlight the difference between marginal costing and absorption costing. So when I'm done with the explanation and I'm done with the highlighting of the difference between marginal costing and absorption costing, so you will permit me to solve question. Is Itoro on this call? Is she here? Okay, I needed to know so I can just terminate this recording. She herself and one other person pleaded that I should record that they are ahead in traffic. So that's why I'm recording it. Okay. All right. So let's discuss this marginal and absorption costing. So when we talk about marginal costing, another name for marginal costing is also known as variable costing, right? Then your absorption costing is known as your total costing. So under under marginal costing, right? What you do basically is that you compute your contribution in the valuation of your product cost, in the valuation of your item cost under marginal costing. You are going to consider only the variable cost, right? You consider only the variable cost in the valuation of your product cost. However, under absorption costing, you will consider both the variable cost and the manufacturing, the fixed overhead cost, right? Any fixed overhead that relate to manufacturing, you will consider that under absorption. So that's just the difference between. So there are basically two differences between marginal costing and absorption costing. The first difference under marginal costing is that the first difference is this. Let me give you the difference between MA and AC. You know what I mean by that now, Abi? Number one difference is on the valuation of items. So under marginal costing, okay? Marginal costing, under the marginal costing. So all costs incurred are treated as a period cost. Here, all fixed overhead, all production fixed overhead are treated as a period cost. I will explain the meaning of a period cost shortly. Then under absorption costing, all production fixed overhead are treated as product cost. So this is just number one difference here. So under marginal costing now, I'm giving you the difference between the two. Under marginal costing, all production fixed overhead are treated as a period cost. So when you are doing valuation of your cost, you only consider variable cost alone. You don't consider fixed cost. You only consider what? Variable cost. But under your absorption costing, you will consider both the variable cost and the production fixed cost under your absorption costing. So you will consider both the variable and the production fixed cost under the absorption costing. That's just the difference, right? So remember that I was specific on the production on the fiscal cost. It is only fixed costs that relate to production that you add to your cost of the items. But all other general fixed costs, such as your selling and admin expenses, those ones are normal fixed overhead, right? They are normal selling and admin expenses. Those one will not be part of your product cost, right? So only those fixed overhead that relate to production, those are the costs that you will consider under absorption costing. However, under marginal costing, you don't consider any fixed cost. You only consider variable costs. Okay, that is why all fixed costs under marginal costing, they are treated as a period cost, because you assume that whatever fixed cost you incur is for the whole period, is for the whole year, not for a specific item. But under the absorption costing, here you are allocating fixed cost to each of the products. That is why under your absorption costing, you treat your fixed overhead as a product cost. But under your marginal costing, your fixed overhead should be treated as a period cost. I don't know if you guys understand the difference between the two, right? What is meant by a period cost and what is meant by a product cost. Under marginal costing, your fixed overhead are treated for the entire year. But under absorption costing, your fixed overhead at manufacturing, they are attached to each specific unit of items. So we're going to practicalize that right away by solving a lower question. Sorry, does anybody have questions for me? I want to give you the second differences. So second differences is method of
Kazim, your voice is skipping.
valuation of closing inventory. Method of valuation of closing. How do you value your closing inventory now? So under marginal costing now, these are the only two
Network is
differences
skipping.
between the two. Don't let anybody deceive you. There are only two differences between marginal and absorption. The first difference is your treatment of fixed overhead under marginal difference. Hello, guys. How is it now? Is it better? Hello?
Yeah, it is fine now. It's fine.
Hello, guys. Can you hear me now? Can you hear me? Hello?
Yeah.
Is it better now?
Yeah, it's better.
Yes.
Okay, I'm so sorry. Please, in case you detect such, let me know, right? I don't even know where you guys lost me from. So let me just assume I have to re-explain the stuff again. Here's what it is, man. Let's move. So, do you understand the first differences between marginal costing and absorption costing? Do you understand these first differences of period and product cost? Or should I repeat it again, please? Quick. I need the response. Should I repeat these first differences?
Yes.
Or it's clear?
Yes.
Is it clear or repeat? I'm confused. There are two responses I'm getting. Clear or repeat? Which one?
Repeat.
Please repeat.
I should repeat it.
Yes,
Okay.
sir.
Okay. Some say clear, some clear repeat. So let me just assume I'm repeating it fast. So I said difference between marginal costing and absorption costing. The first difference is how you valued your items, right? How you value your items. So under marginal costing, all your fixed overhead are treated as a period cost because it is assumed that any fixed overhead incurred is for the entire year. That is what marginal costing believe. It believes that any fixed overhead you incur, whether it is manufacturing fixed overhead or it is a general fixed overhead, that once it is a fixed overhead, it is incurred for the entire year. That's the belief of the school of thought of marginal costing. However, so under marginal costing, I did not say that whenever you want to value the cost of your unit, you should only use your variable cost alone to value. Don't use fixed cost. Use only the variable cost. Don't use fixed cost. That is what the marginal costing said. However, the guys under absorption costing, they said no. Your fixed, first of all, you should distinguish your manufacturing fixed overhead from your general fixed overhead. That's absorption costing. You should distinguish between your manufacturing fixed overhead from your general fixed overhead. So they now said that any manufacturing fixed overhead should be treated as a product cost, meaning that that manufacturing fixed overhead should be added to your cost of items. Whereas under the assumption, under the marginal costing, you don't consider fixed overhead at all. You only use your variable cost. But under absorption, your manufacturing fixed overhead should be treated as a product cost. That means it should be added to the cost of the items, right? So that's just the first treatment I would like to explain to you under first difference between marginal costing and absorption costing. So here, your fixed costs are treated as a period cost under marginal, but under absorption, your fixed costs are treated as a product cost. So the number two difference that I would like to explain before I solve question is the treatment of how you value your closing inventory. So how you value your closing inventory. So under marginal costing, closing inventory is valued using only the variable cost. Okay, you value your closing inventory here using only the variable cost. Very important. You use only the variable cost. However, under absorption costing, okay, under the absorption costing, your closing inventory is valued at the variable cost plus manufacturing fixed overhead. So here, you are going to value your closing inventory using both the variable cost and the manufacturing fixed overhead. So that's the difference between the method of valuation of closing inventory under marginal and the method of valuation of closing inventory under absorption. So I don't know if this is clear to everyone or you still require me to do a further explanation on this. Is this clear, the difference between marginal costing and absorption costing? Is it clear, please? First is on the valuation of items. I've explained. Thank you so much. So now, having said this, now let's take a question now. So I'll be solving. So there are two things I'm going to do here. I want to solve a lower question. Then I shouldn't be doing this other thing again, but I'll take it as a sacrifice. I will also share an assignment with you guys on marginal cost and absorption costing. So in case you're able to attempt it, me on WhatsApp, if you can do that before Monday, I will appreciate so that I can respond to you. But before we do that, I want to solve the question that will always solve for us in the class on marginal and absorption. I want to resolve it again for us tonight here. So we will use that to wrap up on marginal and absorption. Then once we do that, we can quickly move on to standard costing. So that is what we'll take to 11 o'clock before we call it a day. I hope that is clear to everyone. So we'll take that to 11 before we call it a day. That's the standard costing. Okay, sorry, just a minute. I'm checking for something there. Oh. All right, let's go on. So let's go on. All right, the question goes thus: ABC Limited, which currently manufacture a single product A. ABC Limited, which currently manufacture a single product A. A single product A, which currently manufacture a single product A. Has the following sales and cost profile. So we have the selling price per unit, the direct labor cost. We have the direct labor cost and the direct labor cost per unit. Direct cost per unit. Probably it is this should be a material. Maybe I didn't type it well. This should be direct material cost per unit, direct labor cost per unit, variable overhead. Then we have the variable overhead. Then we have the variable overhead, and we have the annual fixed overhead are absorbed. Annual fixed production overhead are budgeted to be 3.2 million, and ABC Limited is expected to produce 1.280 million units of a product each year. So overhead are absorption on the basis on per unit basis. So actual overhead are 3.2 million per year. So budgeted fee selling costs are 640,000 per quarter. Then we're giving the actual production for the 2 quarters of 2023. That is Jan to June and April to June, right? Jan to June and April to June. That is what we were giving as a budget, as a figure. So there is no opening inventory at the beginning of January. So prepare income statement using a marginal costing approach, using a marginal costing approach, and B, absorption costing approach. So this is what we have to do. So we have to prepare the income statement using the marginal costing approach and B, using the absorption costing approach. You know, we have 2 quarters that we need to work with, right? We have 2 quarters that we need to work with. So let's do that fast, guys. Let's do that. So let's use a marginal costing first. When we are done with marginal costing, we will now do absorption. So A, marginal. So solution now. So we have A, why are you, what is wrong with you? A, marginal costing approach. So we have the Q1. We are doing for 2 quarter Q1 and Q2. Okay, now, so let's do the sales. What's the sales now? You know, for Q1, we sold 240,000 units. And for Q2, we sold how much units? We sold 245. So let's make everything in thousand so that we can remove the number of zeros we'll be writing. So can you help me with the sales, please? What's the sales figure for Q1? That is going to be the selling price per unit of 360. Selling price per unit is 360 multiplied by 240,000 here. This one, the selling price per unit of 360 multiplied by 245. Can you give me the sales, please? Fast. What's the sales for each of the quarter? So 360 times 240. So, hello guys, are you with me? You are too, I mean, everyone is quiet now. You're not giving me a figure. Are you guys with me, please? Oh yeah, yes. Give me a figure now.
86.4.
Oh yeah. What about this one?
That is 360 times.
What is the figure?
That is 245. I'm coming up. That is 88.2. Oh. 88.2, yes, correct.
82. Like this,
yes.
Abby? So
correct.
What we have done with your, so we are using, you now say less marginal cost, right? Marginal costing. So first of all is your opening stock. You know, they said there is no opening stock. So your opening stock here will be 0, but there will be opening stock for Q2. Just leave it. I'm using one to Q2 bed. That's what I'm doing. So I'm trying to solve everything together for you. So there is no opening stock for now. So leave it. I mean, for Q1 alone, there will be opening stock for Q2. I will do that when we get there. Now let's other costs. So we have the direct material cost, direct labor cost, and the variable overhead, right? So you bring them down. So for the direct material cost, now, that will be 80. Is it going to be 80? So I want somebody to tell me this. Is it going to be, the direct material cost per unit is 80 naira? So I'm going to multiply it by sales or production. I need a response from someone. Production. Perfect. So 80 times 280 is what? 80 times 280 is what?
22.4.
80.
Sorry, what production?
22,400.
Yes.
Because that's the total that you have produced. You produce, okay, let me explain something. You produced 280,000 in Q1 and you sold 240. That means your closing stock is going to be there. We'll value that later. So what is the labor cost? Unit multiplied by production is how much, please? Labor cost per unit is how much?
32.
Labor cost per unit is 32, Abby. 32 multiplied by the production of 280. How much?
It's 860.
You said?
In your 960.
8,960,000.
960.
Thank you. Then what about 20 times 280 also? 20 times 280.
That is 5.6.
5 million 600. Like this, Abby.
Yes,
So
correct.
this is what we now let's quickly, don't let us waste time. Let's do for this ones too. For Q2, you will now be doing it on production of 240, Abby. So this one will be 80 times 240 is how much? Okay, 80 times. I'm leaving this opening spot blank. We are still going to fill it. So, but for now, let's quickly do the others. In the exam, this is the tactics that I would like you guys to adopt in the exam.
19,200.
Tactics.
19.
19,200. Perfect. Then what about direct labor cost? Direct labor cost of 32 times 240. How much? 32 times 240 is how much?
680,000.
Eh?
7,680,680.
7,680,000. Then what about the third one? The third one will be 20 times what? 240. How much? 20 times 240 is how much?
4,008.
4,000 what? 800.
Yes.
800, Abby. Okay, so this is what we have, Abby. Now, the next thing that you need to do is you will now, okay, in this case now, you add up everything. You will now say, less closing. No, total. What's the total first? Can you give me the total? Total.
36,960.
36,
For quarter one,
960.
960.
Don't do quarter two yet. We are not ready for that. So we now say less closing inventory. I just did quarter two just to manage your time in the exam because you will not have time. Now, closing inventory now. Who can tell me the closing inventory for quarter one? You produced 280, you sold 240. What's our closing inventory?
40.
40,000.
40,000.
So yeah, for quarter one, closing inventory is 40, Abby. 40.
Yes.
Now, what will be the valuation of that closing inventory? Remember that the definition of marginal costing is that you're under marginal costing, your closing inventory will be valued using the variable cost alone, Abby. So if you check now, variable costs are these three: direct material, direct labor, and direct overhead. So 80, 32, 20. That's how much? 80, 32, 20 is how much?
80 plus 32 plus 20.
That's
That is
132.
132.
So you value it at 132. So how much do you have? 40 times 132 is how much?
So that is
Kazim, can you just help us with some notes on these things? So when we are going through again, we can understand better.
Okay, I've said that marginal costing should be the closing stock under marginal costing should be valued using the variable cost only, right? So which is 132. So what is the total now? 40 times 132 is how much?
5,280.
5,280.
1,280.
Now, so as a sharp person now, once you've gotten this 5,280, which is your closing stock, Abby, so that your closing stock in here will be the opening stock here, Abby. So you just bring it 5,280. So I'm using one stock to Q2 bed, though, no time. So total it, what will be the total here for quarter two? Give me. So the closing stock in quarter one is our opening stock for quarter two. How much, please?
So that is 37.4. That is 7,400.
Do it again. That can be correct.
Okay. That is 5,280 plus 19,200 plus 76 plus 4,100. That is 36,880. Sorry.
No, it should be 36. I'm just 36,960. We have 5,280. 5,280 plus 19,200 plus
36,960.
Yeah, because I'm also cross-checking with our lower solution, and all of us cannot be wrong in the class. 36,960. So this is it. Okay.
Okay.
Now,
That one is 7,680.
yes.
76. Sorry.
You get, Abby? So what is the closing stock for now? I want to test you guys now. So in Q1 now, your closing stock in Q1 is 40, Abby.
Yes.
Which
Yes.
is now opening stock for Q2, correct? So if you had
Yes.
opening stock of Q2 40 to pre-production of Q2, how many do you produce? How many will you have now? You'll be having 280, Abby.
Yes.
280. Yes.
And you now sold
Yeah.
245. You sold 245, Abby, out of 280. So what will be your
280.
closing stock? What will be your closing stock for Q2?
That is 35,000.
35,000.
Mm.
So you do 35,000 by the same 132. So how much, please, is our closing stock for Q2?
So that is
620.
4,000.
4,000.
620, Abby.
Yes.
4,620 like this. So
Yes.
just subtract this 6,990. Let me know. 36,990 minus this 30. No, is it the same 36,990 we get for the two of them? 36,960, Abby.
Yes.
Oh, it's the same
minus.
figure. So subtract it from each of these. Let's know what we have.
So you have for Q2 we have 32,340.
32,340.
340.
No, is it for Q2?
Q2 32,340. Q2.
340, Abby.
Yes.
Then what about this one? How much do we have here? 36,960 minus 5,280.
So we have 31,680. 31,680.
31,680, Abby.
Yes.
Yes.
31,680.
80.
Like
Yes.
this. So
Yes.
what is our contribution now? So you get your contribution.
Okay.
So how much is our contribution now? Sales minus this. So you subtract 86,400 minus 31,680. How much is it?
Let's see. So we have 54,720. 54,720.
54.
54,720.
Okay. Then what is the contribution for the other year? I mean, for the other quarter, how much?
8,200 minus 32.
88,200 minus 32,340.
So we have 5,860.
55.
8,860.
Okay, so that is for this. So the next thing you do is to calculate your overhead absorption. So you have over or under absorption of overhead. This is another thing I need to explain entirely. Over or under absorption of overhead. Okay, so let's show a workings for this one separately. Let's show workings for this. Remember that we are still on the margin and we have not done assumption. Once we do this over and order, we are done already. We will just less the other fixed cost from it, and that's all. Or why we even wasting time? Let's consider other costs, Joe. We'll finish those one. We'll finish everything. Then we can move on. If you look at the questions now, they said that annual production overhead 3.2, and it's expected to be 1.2 million units each year. So we have the actual overhead, which is how much? Actual fixed overhead is 3.2 million per year. Actual overhead is 3.2 million per year. So that's for your actual overhead. So it's 3.2 million naira per year. Then budgeted fixed and selling is how much? At the rate of 640. So your budgeted fixed and selling overhead are at the rate of 640,000 per quarter. So you can easily consider budgeted fixed and selling, which is the rate of what? 640 per quarter. So let's quickly bring that in. So budgeted fixed and this thing is 640,000 per quarter. So let's do that. Fixed selling and overhead is 640 per quarter. So you bring that in. You less all your overhead. So we have selling expenses. They said it is 640 per quarter, Abby. So you bring it in 640 per quarter. So I have it here, 640. Sorry, there is another overhead cost that I'm looking for, 700. Is it in the question? If you look at the solution, there is another overhead cost of 700 and 600 that I'm trying to trace. There is an overhead of 700 and 600. Is that in the questions, please? Just a minute.
Let's see
Let
the
me
question.
walk
I'll bring it up.
something. Sorry, I'm coming. I got it. It's clear. Don't worry. I got it. I know what they have done. Yeah, it's clear. It's very simple. I know what they've done. I was just wondering. So, there is also a fixed overhead, which I will show you how to calculate it now. Fixed production overhead, which you will consider. However, you must first show your workings to calculate your overhead absorption rate. You must first show the workings to calculate the overhead absorption rate. So if you look at the questions now, they say that annual fixed production overhead up to be 3.2 million naira and is expected to produce 1.280 per annum. And they said that overhead are absorbed on per unit basis. So, your overhead absorption rate is equal to your budgeted overhead divided by the level of activities, right? That is how you calculate did somebody raise up his hand? I see, okay, nothing. The budgeted overhead is your overhead absorption rate is your budgeted overhead divided by what? The level of activity. And in this case, you are told that your overhead should be absorbed on per unit basis, right? So for us to calculate our overhead absorption rate, so we do 3.2 million divided by 1.280. 1,280,000. So this is how you calculate your overhead absorption rate. So what is your overhead absorption rate now, please? How much? 3.2 divided by
Nice.
1,280. That's how much?
2.5.
2.5. Oh my God, time is running. We've not even done absorption. No? And I still want to discuss standard costing tonight. Anyway, we will end it by 11, regardless. So 2.5 is our overhead. So your overhead absorption, your fixed production overhead will now be this 2.5 multiplied by production. Okay? You multiply it by your unit of production. So in quarter one, we have produced 280 units. So our total overhead for quarter one should equal to 2.5 times 280. So that gives us how much, please? 2.5 multiplied by 280. That gives us how much?
700.
700. So that's our overhead for quarter one. Then for quarter two now, it will be 2.5 multiplied by 240 because that's the production for quarter two. Abi, if you check, they produce how much? 240 in quarter two. So that gives us how much, please? What's
600.
our
600.
600. So one more thing that you need to do, you now need to calculate whether this overhead itself it was under absorbed or over absorbed. So if you look at the question, they said that there is a place they made one clause. Let's read it again. They said annual fixed production overhead are budgeted to be 3.2 and ABC is expected to produce 1.280 million of a product each year. So what you have told them to do is that they should produce 1.2
Hello, KZ.
Eight million of a product each year. So based on this production now, this overhead of 2.5 million, 2.5 naira has been computed. Guys, hello, can you hear me? Can you hear me, please?
We can't hear you clearly again. Oh.
Hello, can you hear me? Now, can you hear me now?
Yes, now.
Oh, all my networks.
It's better now.
All my
5 minutes
networks
ago.
they are messing me up. My MTN messed me up. Airtel is messing me up. Even my broadband too mess me. Everything is just messing me up tonight. I don't know. Is it general or just me alone? I don't know.
It's not
It is
general.
well. It's me alone, Abi. I don't know. Okay.
Yes,
Let's sharp
You have
man.
not.
We have about 30.
I've not gotten.
If you have
Okay.
Airtel, can you Airtel?
I have Airtel. Airtel is one I'm using now. See, I have about 3. How many networks here? You can't see about 4. Okay. Can you? I'm sharing my screen now. Can you view my screen? Hello, can you
No.
view my screen?
Not yet.
Oh, really? Okay, let me stop
Yes.
and share again. I'm sharing again. I've stopped. Okay. Just a few seconds. Please let me quickly restart my MTN. Maybe it will come up again. Just a few seconds. I'm coming. Okay. If you guys want me to compensate you, I can compensate you. I can stay till 11:30 if you want to. So if you want me to compensate you, I can stay till 11:30. Okay. Just hold on. I think MTN should be fine now. Yeah, thank God I can see it. Let me switch over to MTN. That should take us through the end of the class, please. Yeah, finally MTN is up. This one doesn't disappoint me. All right, can you hear me clearly?
Yes, but I can't view.
Can you guys hear me?
Yes. Yes. Very
Can
clear.
you view now? Can you view now? Can you view?
Not yet.
MTN is up now. Okay, can you view now? Can you view? Can you
Yes.
view?
Yes. Yes.
Okay, yes, you can view.
Can
So,
Yes.
thank you so much. So, do you understand how I got this fixed to production overhead 700 and 600? Right? It's clear, Abi.
Yes.
Hmm? So we want to calculate the last thing. One more thing is to calculate. We need to calculate whether there is an under absorption or over absorption of overhead. So I told you that in the questions now we're told that this overhead of 3.2 million computed using 1.2 million, 1.280 units of a product for each year. However, we need to test it whether truly what we produce is up to that. So let's calculate computation of over or under absorption of overhead. We need to calculate that whether we have over absorbed or under our overhead. So what is the target production? Target production per quarter. Okay, what did they say we should do per quarter? Okay, in Q1, Q1, Q2. So remember they said we should produce 1.280 million per quarter, right? 1.280 million per quarter. So let's do that now. So meaning that if we are to do 1.28 million per quarter, it's going to be
per year.
It's going to per year, sorry, per year. So per quarter will be how much, please? Per quarter will be how much? 1.280 divided by 4.
320. 320. 320.
Per quarter will be 320, Abi.
Yes.
Oh, sorry, I don't want to give up tonight, but this thing is really frustrating me to give up. But I won't give up. Can you view my screen and can you hear what I'm saying now, please?
Yes.
Network is really frustrating me badly. Yeah. All the network, everything is messing up at the same time. Airtel, MTN, everything. Okay. So this is our target production for each of the quarter. Now we will now check what is our actual production. You remember that overhead has been absorbed. Overhead have already been absorbed using this 320,000 units. That is how the overhead was absorbed. So we will now check what is the actual gogon that we produce. So we go and check your production now. In Q1, you produce 280. In Q2, you have produced 240. So what do we have? In Q1, we produced 280. In Q2, you produced 240. So what is the difference really? What is the difference? So the difference simply means that what it's saying is that we have over absorbed. You know, what we have produced is what? Is 320, 320. But I mean, what we produce is 280 and 240. But we have absorbed overhead using 320,000 quantity. So we have over absorbed by how many quantity, please? How many quantity do they over absorb? Here we have over absorbed by 40,000, Abi. And here
Yes.
we have over absorbed by how many quantity? Yeah, this should be 80, Abi.
80. Yes.
We have over absorbed by 80. 80, yes. So what is the OAR, overhead absorption rate? It is 2.5. 2.5. 2.5, right? So what is now the over absorption? What is the over absorption in value? What is the over absorption in value? The value is how much?
Right, 100 for quarter one.
This will be 120, Abi. Is it 100, Abi?
100.
Yeah, 100.
Thank you. Yeah, quarter two is how much?
That is 200.
It's 200, Abi. So if you over absorb, it's just like a profit to you. Over absorption is like a profit to you, right? It's like a profit. So you come here, over absorption of overhead. This will be 100, and this will be 200. So so what is the final profit? I am done now. I am finally, at last I am done with marginal. What is the final profit for each of them now? Final profit is how much? Final profit. How much is the final profit, please?
You are coming
Hmm?
up. 4720 plus 100 minus 700 minus 640. That is 33480. Quarter
Hmm?
one. Quarter one or
How much?
53480. Quarter one. Someone should confirm.
Then quarter two, uncle. Yeah, it's
So we
correct.
have
Quarter two is how much? What is quarter two? What is quarter two?
I'm coming up.
Hmm.
That is 54820.
5 4.
820.
Okay, ladies and gentlemen, this is the end of this is how you treat your marginal cost here. So let me quickly revise it again. Then absorption will not take us like 10 minutes to do because most of the figure we already have most of the figure. So if you check now, our sales is clear, right? Our marginal costing was done using the variable cost alone. That's the material labor overhead. Then our fixed cost was separated here. You can see we got our over absorption here, selling price and the fixed overhead here to be able to arrive at a final profit. So let's do B. We'll do the same thing using absorption.
Sorry, how
We
do
want
we
to do
get
it
the
now.
contribution, please?
How do we get the contribution? I'm coming. Absorption costing. How did we get the contribution? So contribution is simply your sales minus your total variable cost. That's contribution. That's your 5280 minus your 86,400 minus what? Minus 31,680. That's your contribution, sir. Do you get it? 31,680 minus 86,400. Yeah, your sales minus variable cost is your contribution. Is that clear?
Okay.
Okay, let's do absorption costing. So guys, for absorption costing, we'll copy this. Sales is the same. All these are the same. Up to here, we'll just watch me, please. Watch me. So they are the same up to this point, right? So now for absorption costing now, we have considered the sales. We'll take less absorption costing. So we've considered the sales, okay, opening stock. This one we change to. We've considered all the direct material, direct labor, direct overhead. So the next thing you will now introduce is your fixed overhead that you absorb, fixed manufacturing overhead. You need to introduce it. Now, what is the fixed manufacturing overhead? Hello, fixed overhead, manufacturing overhead is what we have computed as our overhead absorption rate, which is 2.5, right? So this 2.5 is our fixed manufacturing overhead. So you will simply, where is the solution in? You will simply multiply this 2.5 by the production for each year. So it will now form part of your direct cost under absorption costing. So 2.5, that is your fixed manufacturing overhead. You multiply it by how many was produced by 280 for quarter one and 240 for quarter two. So what is that? So 2.5 times 280, how much is it? That's for quarter one. 2.5 times 280 is how much, please? Oh yeah, 2.5 times 280 is how much?
700.
700 now.
What about quarter? Okay, we've already done it now. What about quarter two? That should be 600.
Yes.
So you can see under the marginal costing now, this overhead was not used as part of our product cost, but under absorption costing, you must use this overhead as part of your product cost. So now, what is the total product? What is the total now? Give me the total, please. Total. Then we'll less closing stock from it. What is the total? 22,400 8960 plus, let me do my own too. 22
One
for, eh?
3760.
3760.
37660, Abi.
Yes.
What about this one?
We have not put opening stock. Opening stock.
192. Oh, sorry. We have not done opening stock. So we'll say less closing stock. So your closing stock is the same. Your closing stock is how many units sell? That's you produce 280, you sold 240. Your closing stock is 40, Abi. So your closing stock is 40. Your closing stock is 40,000. Now multiply by the total cost here is how much? Hello, the total cost is 132 here. Are you with me? The total cost here is 132, correct?
Yes.
It's one, so it will just simply be 132 plus that 2.5. The 2.5 that you have 132 plus 134.5, Abi. So that's 134.5, Abi.
Yes.
So what is the answer, please?
That is 5380.
5380. 5380.
80.
Like this, Abi.
5380. Yes.
Okay, so this 5380 is our opening stock here.
Sorry, Susie, I'm sorry. How did you get 4.5?
How did we get?
4.5.
How did we get 134.5? So
Yeah,
we
they
got
use a
134.
stock.
No, I'm not getting it.
The 4.5.
The 134.5.
Yes.
It is simply the 132, which is the total variable cost, plus the fixed overhead absorption rate of 2.5.
5. Okay, thank you.
Yeah, that's how we got it. Okay, it's clear, Abi. So
Yeah,
you have this. So you have this now. So what's the total here for year two? What's the total? The
Same
total
thing.
for
3760.
37.
660.
37, are you sure?
Yes. Let me do it again. Thank you.
Okay, 37,660, you are correct. 37,660. Now, what is the closing stock for the second year now? So the closing stock is here we have 40,000 left in Q1. We have 40,000 left in Q1, correct? We will add that 40,000 to Q2. That's 280, Abi. Then we now sold 245. So what will be the difference? 280 minus 245 is what?
That is 35.
35,000, right? So we have 35. Yeah. So here it will be 35 times 134.5. That's how much?
4707.5. 4707. 4707.5.
Yeah, got it. So what's our, so what is our this thing now? What is our
32952.5 for quarter two.
32? No, we are starting with quarter two, Abi.
Yes.
32 what?
952.5. Let's see from
then
sales.
what about quarter one?
Okay, that is
32,280.
32?
280.
280, correct, like this. So what is it gross profit or what? What's my gross profit? Then we'll less the piece overhead from it. What's my gross profit?
54,120.
54,120. Then what about this?
That is 55,247.
65,
55,247.5.
55, 247.5.
2.50.
Like this, Abby. Then so your overhead absorption rate is the same. So you're only considering two things now. Let's go to marginal costing and just bring it. We're only considering this overhead absorption rate and the fixed and the selling expenses. That's all.
Okay.
So you know, because the production cost itself, I mean the fixed manufacturing overhead has been considered as part of our product cost. So what's the final profit? That's the end of this question. What's our final profit, please? How much? What's our final profit?
53, 53580. 535.
53580. 53580. And what again?
Just a minute, please. 5,247.5. Yes. So we have 54807.5.
Okay. So, ladies and gentlemen, we are done with marginal and absorption costing. I know this might look a little bit complicated, but nothing is complicated really. My advice is at your leisure time, not too long, right? Just pick up this question and kindly solve it again. So there is a question that I also want to post on the forum. If you have time, it's voluntary, right? Same on the same topic. If you have the time, please, I'll be glad if you can practice the question and share the solution with me before Monday or anything you send after Monday. Me, I know they read again. No, I'm already preparing for corporate finance and economics, but I can still sacrifice between us Monday to attend to your request. Otherwise, I will not even respond again because I will be preparing for my paper. So if you can attempt the question between us Sunday, I will respond to your answer. That's on marginal and absorption. I want to give you another question, different from this one, but the same approach. Please attempt it. Time you attempt that one, you will be fine. Okay. So the time, wow, many people have gone already. The time
Okay.
the time is 10:45, and I still have standard costing to cover. Should we just knock it down here?
Yes.
Let's knock. Okay,
Okay.
Aziz speak, then let's knock it down. So this is our
Yeah.
last session on financial planning. Aziz, I'm with you.
Easy.
Speak.
Yeah,
Yeah.
I saw one question one time like that overhead absorption rate is when we are computing profit for absorption. But the one we are doing that Prof taught us, he put the Prof include the over or under in marginal this thing. Is it like that?
It's not. This is what we have done now. See, under marginal costing, your closing inventory, you don't consider your fixed. Then you consider your over and absorption after contribution. This is the same thing that we've done here. Then under
Okay, it will be
absorptions, it will be
marginal.
after contribution under marginal, yeah. Then after under absorption, it will be after gross profit, yeah. So as I was saying, this is our last session on financial planning. So hopefully all of us will share one or two good news in the exam hall. But I will share a question with us now on this marginal and absorption. If you can attempt it, fine. Otherwise, all the best. But please, whatever we've done, kindly practice. I will reshare all the material on financial planning now. Please go through all our questions. There is no way they will not repeat from everything we've done since February. There is no way they will not repeat it. It's possible that all your questions are even part of what we have done before. So I would just like to wish you guys the very best. We have one more class, which is on Sunday. I'm excited to host that class. That will be the grand finale. Grand finale Sunday on corporate finance. That will be the final class, grand finale for this semester. So please watch out for that on Sunday, 5 p.m. Okay, for now, it's time to say goodbye to everyone. Have a wonderful night rest. See, we'll meet in class tomorrow by God's grace. Bye-bye to everyone.
Thank you so much. I'm grateful.
God
Yeah,
bless
thank you.
Thank you.
Thank you.
Much.
Boy.
Hey, these are the people sleeping. Oh, I don't catch them. Oh, Grace sleeping, Fatima, Abi, Ebere. Okay.
The